Greetings. This presentation reviews ABC companies' treasury challenges and our recommended solutions. We evaluate three broad key sections. Firstly, the currency risk management section. Secondly, the liquidity and cash management section. And thirdly, the surplus cash investment section. Our work is further organized into certain suggestions that we recommend implementation of to address each of these three key sections. As far as the currency risk management section is concerned, we deal with how to manage foreign exchange exposure and build forecasting and monitoring models to help increase exposure transparency. For the liquidity and cash management section, we discuss how to optimize liquidity, increase cash levels, and working capital across centralized and decentralized entities. And lastly, for the surplus cash investment section, we talk about how to deploy the excess liquidity created from our various implemented solutions in a manner that takes into account both our risk appetite as well as the various regulations that we have to cater to. For the first one, currency risk management, we recommend a 5-step hedge framework which involves mapping gross exposure and arriving at net exposure with provisions for natural hedging as well as cash pooling and transfers in between these two steps. For liquidity and cash management, our main solution entails cash pooling, which is through the integration of the enterprise resource systems of SAP S/4HANA, as well as AI treasury extensions, namely Kyriba, into ABC Company's treasury management system. Lastly, for surplus cash investment, we recommend the connection of the integrated treasury management system to our portfolio management system through a live data feed. This in turn ensures dynamic portfolio allocations to various subsidiaries. Moving on to the next slide. In our second slide, we deep dive into the solutions relating to question 2, the overall hedging strategy required for ABC Company to implement. We suggest the implementation of a 5-step currency hedging strategy, which has the following steps. Firstly, risk identification and mapping. Secondly, natural hedging. Thirdly, cash pooling. Fourthly, net exposure and estimation. And fifthly, hedging programs. Our risk identification and mapping step aims to classify various foreign exchange exposures into three main categories, namely translation, transaction, and economic risks. This allows for better visibility as well as control of such risks. The purpose of this step is to ensure that there is clear knowledge and transparency about the current foreign exchange exposure levels of ABC Company. We will track risks through various key performance indicators and use defined metrics supported by standalone and consolidated dashboards. Our second step of natural hedging takes into account currency matching across various subsidiaries. Over here, we look to match the revenues of the subsidiary to the expenses of the subsidiary. For example, a subsidiary of ABC Company based in France earning in euros should ideally try and match its revenue stream to vendors who accept payment in euros. Similarly, this can be done for various other main currencies such as the US dollar, the euro, and the Great British Pound. This allows for a certain degree of internal settlement of the initially identified gross exposure. Our next step of cash pooling and transfers takes into account an integrated treasury management system through which all subsidiaries submit their forecasts of their cash flow, and foreign exchange requirement positions for certain periods of time. The Treasury Management System compiles this data into one centralized geography segregated dashboard and additionally matches areas of foreign exchange excess to areas of foreign exchange deficit. For example, if the United States of America subsidiary has an excess of US dollars of around 60 million and the Germany based subsidiary has payments to be made of $12 million, the US surplus will be matched to the Germany deficit. This matching and payments of surpluses to deficits is done through a central balance account where all the surpluses are first gathered and then paid out based on our estimations. Next comes the step of net exposure estimation. This is where all your foreign exchange exposure that is remaining after internal settlement is estimated and calculated in order to determine that share of exposure which has to be covered by external instruments such as forward, swaps, and options. Finally, our hedging program takes into account an incredibly detailed foreign exchange policy which defines various metrics such as hedge ratios, permitted instruments, time horizons, prohibited activities, and various other particulars as well. Our hedging program follows the style of Toyota, which looks for minimization of cost and maximization of effectiveness. Next, we move on to the solution for question 1, which is addressing specific foreign exchange exposure risks in the country of Nigeria. As far as Nigeria is concerned, we first plan on monitoring USD reliance through various KPIs, hedge ratios versus forecast imports, confirmed LC utilization, vendor USD days payables outstanding, share of local sourcing, and PAPSS routed collections are just a few examples. As far as offshore critical vendors are concerned, we look to secure confirmed letters of credit where correspondent USD appetite is weak. In addition, we plan to leverage continent level facilities to guarantee shipments as well as timing. For intra-Africa trade, we use PAPSS to settle in local currencies and remove the intermediation of the USD currency where counterparties are connected. This reduces conversion costs as well as speeds up goods release. For local Nigerian suppliers, we pay in Naira with NFEM indexed contracts and short-term repricing clauses to reduce the demand and reliance we have on USD and decrease foreign exchange stress. Hence, we prefer currency matching and local sourcing in order to solve the problem of money getting locked up in Nigeria. Moving on, we come to the various KPIs and metric system that we have in place in order to measure the effectiveness of our hedging strategy. This slide sets out to talk about 4 broad methods. Firstly, the dollar offset method. Secondly, the Monte Carlo simulation. Thirdly, volatility reduction. And fourthly, regression testing. The dollar offset method measures how much of the derivatives offset the underlying exposure across various maturities, and it is reported as a percent of periods within an effectiveness band and also a percentage of cumulative ineffectiveness. The Monte Carlo simulation runs various scenario stress tests for foreign exchange moves, delayed collections, and funding shocks. The volatility reduction method compares earnings and cash flow volatility versus an unhedged baseline. This tracks residual volatility and the trend of the overall reduction of the volatility as well. natural hedges are prioritized, and then come the derivatives. Regression testing validates statistical relationships between hedge instruments and various exposures. The KPIs for each of these methods have been deeply researched into and mentioned in the flowchart as well as spoken about in detail under each of these topics. Moving on to question 4, where we have built an integrated ensemble that allows us to forecast the USD to INR prices for the next 5 to 6 months. This model of ours is a combination of two fairly commonly used models. One is the long short-term memory model, or LSTM, which captures various time series patterns, momentum, and seasonality, along with the random forest model, which uses various other macroeconomic drivers such as inflation, crude oil prices, trade balances, and various others. And our integrated model looks to deliver one overall picture of exactly how the USD INR price acts 6 months down the line. If you take a look at the various model parameters given on the bottom right of the first graph versus the model parameters on the bottom right of the second graph, this talks about various changes in the parameters of the random forest metrics, and the yellow dark line provides you the forecast for the next 6 months, as well as the light yellow shadow providing you the standard deviation from the expected values. Through this, we ensure uniformity as well as accuracy in the forecasts we make of the USD to INR price. Now, we look to address the fifth question and the last one under our currency risk management section as to how generative AI could be used to mitigate currency risk. We have developed 4 different possible areas where Gen AI could help. Firstly, with enhanced forecasting models. Secondly, with automated hedging recommendations. Thirdly, with dynamic exposure monitoring. And fourthly, with sentiment or news related analysis. The impact on ABC Company in all 4 cases is incredible. For instance, in the first case of enhanced forecasting models, it enables the Treasury to anticipate various currency swings on the 60% export revenue base that it earns. This helps to minimize and cut out any future risk associated with forecasted exposures. For the automated hedging recommendations, it reduces the bias associated with manual decision making, and it maximizes the efficiency of our currency hedging strategy and lowers the costs related to hedging by approximately 15 to 20 basis points. For dynamic exposure monitoring, it ensures for ABC the instant visibility into various open positions and exposures that it may be affected by. And by analyzing various sentiment and use related data, it allows preemptive hedging or repricing before various macro events and gives ABC an edge over the rest of the market. Next, we move on to the presentation of our treasury management system integrated dashboard. As was stated earlier, ABC Company's TMS proves to play a pivotal role in ensuring that it limits its exposure to foreign exchange risk. On page 1, it shows the various submissions of each subsidiary's forecasted currency inflows, outflows, and overall surplus or deficit, and in which currency it is for the same. On page 2, we find a summary of the total surpluses and the deficits of various subsidiaries by currency, along with a highlight for which currencies are in a surplus and which are in a deficit. On page 3, we see the display of various surplus currencies and how they are used to fill deficits for the currencies which are currently in the red. And on page 4, we track the overall foreign exchange pool and the various transactions that occur in order to match foreign exchange surpluses to deficits. Through the slide 9, we look to move on to our second section that we deal with, that is liquidity and cash management. We are addressing both questions 6 and 9 together on this slide, as we found various connections between the solutions. Our overall 3-step outlook is firstly to ensure global cash visibility, that is a unified cash view that allows us to find transparency across the 50 plus countries we are operational in. Secondly, the development of a forecasting framework that is supported as well as integrated with AI and various other inputs from other systems. And next, we look to test the level to which our company can handle shocks in the receivables that it earns. Our core building blocks for this are as follows. Firstly, our enterprise resource planning systems, or our ERP systems, will be integrated with SAP's S/4HANA in order to ensure real-time two-way data syncing. Our forecasting engine is an extension of a treasury management system using Kyriba AI, which specializes in forecasting the days payables outstanding, the days sales outstanding, and days of inventory on hand, which allows us to forecast the cash conversion cycles in various geographies and for various subsidiaries. In addition to this, we are connected with a centralized bank which helps us plan the entire process out. In the center of the slide, you look at the scenario and stress testing. In this financial model, we have modeled a 10 to 30% slowdown in the collection of our receivables across key markets, as well as for different levels of revenue. And as can be seen, according to the liquidity buffer, which we have arrived at, whose calculation will be explained at a later stage, ABC company will be able to cover anywhere between 21 and 28% of a downturn in its receivables. Hence, with a solid base in cash visibility, with our solid ERP systems through S/4HANA, an integrated forecasting framework with Kyriba AI, and a stress testing model in order to protect us against receivable downturns, we manage cash visibility, forecasting, as well as stress testing framework, which helps improve overall liquidity positions. Now, we move on to address question 7 in slide 10. Question 7 deals with specifically cash pooling across various subsidiaries in order to manage, maximize, and optimize liquidity. The slide is divided into 2 parts. Firstly, the various benefits that ABC company would accrue from the process of cash pooling. Namely, it helps balance short-term debt, it helps reduce overall transaction costs, and it provides a consolidated and centralized cash view system in order to know exactly where ABC company's cash is at any point of time. As far as how we are going to be pooling and transferring cash across subsidiaries, we will be using a zero balance account structure, which is a structure wherein at the end of each business day, each subsidiary's account is swept into one centralized master account, leaving each subsidiary account at 0. And once the balance is collected in the centralized zero balance account, Our treasury management system further aims to address and match areas of cash excess with areas of cash deficit. This treasury management feature will be discussed in detail at a later stage. As far as the impact that the overall cash pooling system using a ZBA has, you can take a look at the infographic given on the page, which talks about the systems of payment before the netting is implemented on a zero balance level versus after it is implemented. Hence, it is very visible that one netting center is responsible for managing the cash and liquidity levels of each of the subsidiaries. In addition to this, we also recognize the importance of having a banking partner across the globe to support our operations. Hence, we have arrived at Credit Agricole CIB, which will be our partner as it provides specific physical pooling opportunities through zero balance accounts for both domestic and cross-border transactions. In addition to this, they provide various other payments, investments, and short-term financing solutions. Our next slide, 11, aims to address question 8, which talks about working capital optimization, as well as the optimization of receivables, inventory, and payables. Our solution to this problem is a 4-step one. Firstly, we optimize working capital across all 4 levers by implementing the following. First, we accelerate receivables. We enforce e-invoicing, virtual accounts, and straight-through cash applications to lower the days sales outstanding by approximately 3 to 6 days. We use various artificial intelligence and machine learning models for risk-based collections, dynamic discounting of our receivables, and financing these receivables where we deem appropriate. The second step, inventory management. We apply multi-echelon optimization as well as ABC or XYZ SKU rationalization to release approximately 10 to 15% of working capital and reduce the days of inventory we have on hand. We consider vendor managed inventory and postponement to cut our pipeline stock. The third step is where we extend our payables. We standardized payment calendars, use virtual cards, and evaluated receipt settlement to safely push the days payables outstanding upward while supporting supplier liquidity. We take advantage of the longer periods of credit provided by suppliers in countries where possible in order to increase the overall DPO. And lastly, we talk about structural and cost-cutting levers. This takes into account milestone billing, channel financing, multilateral netting, and various optimized trade instruments to reduce the letters of credit and free collateral that is blocked. The overall impact that we will measure is through the cash conversion cycle equation of days sales outstanding, days inventory on hand, as well as after subtracting and accounting for days payables outstanding, and convert the days saved into cash release using the annual revenue base. Next, we move on to slide 12, which is the exact and identical display of how our integrated treasury management system works. This as well, like the previous dashboard, is divided into 4 pages, however, specifically deals with cash and liquidity related issues. On page 1, we see the updated real-time cash positions after foreign exchange swaps for each and every subsidiary, along with comparisons of pre and post swap balances and liquidity impacts. This is done due to the fact that our ERP system of SAP's S4 HANA is integrated into our treasury management system. On page 2, you can see the integration of receivables and payables data to display exactly how any internal fundings from swaps would help cover up upcoming payments and reduce reliance on external financing and short-term borrowings. Page 3 includes yet another integration into our TMS of the Kyriba AI Treasury Management extension. This AI extension will help us predict and forecast the days sales outstanding, days of inventory on hand, as well as the days payables outstanding across various subsidiaries and geographies, and hence will also help us account for the cash conversion cycles in each of these geographies. And finally, on page 4, we can see the master ledger of AR, AP, and various bank data that feeds into our dashboard. This allows drill down into invoices, into balances, and into specific transactions. And hence, we see the real impact of S4 HANA's as well as Kyriba Treasury Management's AI extension into our TMS dashboard. Finally, we move into our third and final section of surplus cash management and investments. Over here on slide 13, we address question 10, which talks about the various policies that ABC companies should employ for investing its surplus cash. Overall, it can be divided into 4 steps. Firstly, segment cash based on its liquidity. Secondly, outline the permissible investments and risk appetite and tolerance levels. Thirdly, enforce various governance and control measures to ensure smooth execution of these policies. And lastly, efficiency and compliance to ensure that all of these policies are implemented in real time. Firstly, by segmenting through liquidity, we classify our cash reserve into 3 segments or 3 cash pools. Firstly, operating cash pools. Secondly, reserve cash pools. And thirdly, strategic cash pools. This is in order to ensure that we know what to do with specific amounts of cash. Permissible investments and risks outlines what must be done with each segment of cash that we arrive at, as well as what is the maximum risk that can be taken while investing a particular amount of cash. Governance and controls outlines clear roles such as board approval policy, treasurer oversees, execution points, as well as internal audit points in order to ensure compliance with regulatory as well as internal policy norms. Lastly, we talk about efficiency and compliance, where we invest true surplus cash efficiently, considering specifically after tax returns, and we avoid keeping funds idle. Also, this step ensures that our investment policies are in line with the regulations of the various subsidiaries and countries that we operate in. The right side infographic aims to talk about the split in the cash reserves based on the 3 cash pools, namely operating, reserve, and strategic. Next, on slide 14, we address the 11th question, which talks about the specific investment decisions of ABC company. There is a 3-pronged tool that we use to deal with this question. Firstly, liquidity-driven deployment of funds, and secondly, controlled yield enhancement in the reserve pools. Under liquidity-driven deployment, we look at the split that the operational pools, reserve pools, and strategic pools have in the overall cash contribution. The region-specific capital mobility is monitored as well, specifically according to continents, Europe, North America, South America, Africa, Asia, and Australia. Our overall risk level is outlined in the matrix given below. It talks about liquidity, credit, interest rate, market, and regulatory risk that each classification of cash pool will be willing to accept during the course of investments. The model on the right aims to take into account both our risk compliance metrics as well as the regulatory metrics specific to the geographies that we operate in. The assumptions outlined are regarding revenue levels, the percentage of surplus to revenue, as well as the surplus amount that is being assumed. The final surplus amount is 1,400 rupees crore. Our risk appetite pools for operational reserve and strategic have been outlined as percentages as well, which essentially means that from our overall cash pool, 10 to 15% will be operational, 25 to 35% will be reserve, and 50 to 60% will be strategic pools. In the table given below that, it segregates cash pools by continent as well as by the pool type, and also what percentage each continent contributes under each pool type. Overall, we can see in the rupees crore contribution, the final amount that each of the 6 functional continents have under each pool type. The local reserve requirement column aims to take into account regulatory limitations on exactly what percentage of cash surpluses businesses are supposed to maintain within the continent. The maximum foreign investment column deals with what percentage of cash surpluses companies are allowed to invest outside a continent. And hence, after thorough calculation and estimation, we determine that the amount eligible for investment, that is within as well as outside the continent, will take into account specifically the local reserve requirement and be adjusted to it, whereas the amount eligible for investment outside the continent takes into account the local reserve requirement as well as the max foreign investment permissible as a percentage. The final table below that looks to address exactly what investment objectives, solutions, and decisions we will be taking for each of the segregated segments of cash pools by continent and by pool type for both the centralized investable funds, which is a summation of the maximum foreign investment permissible by each continent, as well as the investable amount within the continent, which is the difference between the total amount investable and the local reserve requirement after accounting for the foreign investment deduction. The 15th slide of our presentation looks to address the first part of investment allocation of our cash surplus portfolio while integrating our treasury management system with the features that it has had so far. Firstly, we need to determine our treasury management system's status, which is relevant from the bottom left given chart. So we look to integrate our treasury management system to our portfolio management system. How? Kyriba's AI treasury extension and SAP's S/4HANA look to be the bridge for getting together the TMS to the PMS. On the top left, the centralizable investable amount, which is the amount which can be invested outside each of the continents, is summarized by the continent as well as by the cash reserve class. For example, 16.54 crore rupees of Asia's operational cash reserve can be invested outside Asia. Hence, we determine that a total of 451.5 crore rupees can be centralized at Mumbai HQ and invested from there. Our acceptable risk levels for each type of cash flow is outlined again in the table on the right side. The quantitative aspects of the centralized investment portfolio are as follows. Essentially, the functions would be to gather the 451.5 crore that can be invested internationally according to the maximum foreign investment percentages mentioned earlier into one centralized balance holding account which is managed from Mumbai, which will be distributed as operational reserve and strategic pools. The table on the bottom right looks to talk about the investment priorities of the operational, reserve, and strategic cash pools, as well as the specific instruments which we will be investing this centralized cash pool in. To name a few, in the operational pool, Government of India 91-day T-bills and certificates of deposit of high credit quality. In the reserve pool, AA rated corporate bonds as well as arbitrage mutual funds may be employed, as the return and risk is more balanced for reserve pools. As far as the strategic pool is concerned, it is a long-term commitment and hence looks to lock in money in longer term investments and get a relatively higher rate of return. The tolerance level of risk across liquidity, credit, maturity, etc. increases as you move from the operational pool to the strategic pool, and each investment vehicle is outlined in the table. The quantitative assessment of our operating, reserve, and strategic pool portfolios are given in the table in the middle on the right hand side of this slide. Our final slide of the PPT, that is slide 16, aims to address the investment principles, vehicles, and instruments used for the remainder of the cash reserves, operational reserve, and strategic pools, which have to be compulsorily invested within each of the specific continents. For example, if you take a look at the left hand side top table, within the continent of Asia, the 49.61 crore operational reserve, the 82.69 crore reserve pool, and the 198.45 crore strategic pool all have to be invested within the continent of Asia, as these values have been adjusted for the minimum domestic requirements as well as the maximum foreign investment allowances. Hence, we arrive at a total of 843.5 crore Indian rupees which have to be invested in respective continents as outlined by the model on the left hand side. Our risk level is outlined yet again on the top right hand side table, and on the bottom right hand side is where we delve into the specific instruments that we choose to invest in each of these continents. For example, within the continent of Asia, our operational cash pool will be invested in Government of India 91-day T-bills, the Chinese government's 3-month bonds, as well as Singapore MAS bills. Hence, each investment instrument, strategy, and portfolio looks to incorporate various elements of risk and aims to reduce those by diversifying across different instruments but within the same continent. Hence, we have now dealt with the entire cash pool of 1,295 crore, partly invested at a centralized basis for the amount that is allowed to be withdrawn from the continent, and the remaining which is invested in their respective continents due to certain regulatory restrictions within each of these geographical boundaries. Last but most certainly not least, we would like to thank you sincerely for taking the time to listen to our presentation and go through our solutions in depth. This overall presentation has looked to address the overall treasury systems related problems that ABC Company, as a global trading and manufacturing business, has been a victim of. The three sections we have divided this PowerPoint presentation into aim to discuss in-depth solutions to each and every one of the problems in order to ensure that in the future ABC Company can move on to prosperity and increased business development. Thank you.